Yeah, am I audible? Visible? All fine? Thumbs up? Fantastic. So, today's discussion is about globe loss election. I told you in the last class, globe loss election is something different. So, we will discuss about it. Now, what exactly is globe loss election? Okay, whenever there is cover tax, do you think that it includes what and all it includes? It starts with current taxes, right? Current taxes, whatever is the amount that is provided in current taxes, you have to, that is the starting figure. Then there are some additions, subtractions, etc. with respect to current taxes. For example, like the excluded income, you need to, taxes on excluded income, you need to subtract, right? And taxes, which is defined as cover taxes, all that cat 1, cat 2, cat 3, cat 4, those which are not available in P&L, you have to add. So you remember all the additions and subtractions? Yes or no? Okay. Now, and then we would add to that, or after all the additions and subtractions, we will add to that what? We will add DTAA, which is deferred tax adjustment amount, which is calculated separately. Right? Now, deferred tax adjustment amount is also having so many additions and deletions. If we just remember, so you start with deferred tax expense, then rate cap adjustments, mandatory exclusions, recapture rules, transitional provisions, too many things to add and minus. Yes or no? See, this is going to get a little overwhelming for smaller clients, right? I mean, doing all these adjustments just on the deferred taxes. Would you agree with me? So globe laws election is a means by which it's a simplified adjustment. So you don't need to do all this that is there in Article 4, 4.4. So rather, all the adjustments that's provided in 4.4 in terms of deferred tax are not current tax. You need not do that. You can take an election. It is an election that you have to take in the first period. Okay, it is revocable and all. Don't worry, it's not it is not irrevocable. So that means it's revocable. And this is a simplified way so that you can keep your deferred taxes in check and do not go through all these things. Which is the most notorious thing in all this? Which is the most notorious adjustment which needs a lot of compliance? You tell me. Which is the most notorious one? Okay, I'm getting answers. Sahil is saying recapture. Absolutely, Sahil. Recapture is pretty hard because you have to track all the details, either in FIFO or LIFO, and see if whether they are getting reversed within 5 years or not. Absolutely, that's a big pain. If you are a small entity with or a jurisdiction in a small entity with just one accountant or something, it's going to be ridiculously hard for you to track all these things. So that's why, to save you guys or give you an alternative option, there is a globe loss election. Now, why do you think it is an election? Because you can only take it if it is advantageous for you. This, mind you, has a lot of disadvantages also. It could really screw up your cover taxes as well. Okay, you can bring down the denominator, thereby bringing down the ETF. So you have to be very careful when to choose this election, and what this election is, we will understand. Okay, so with that background, we will start the session. So this chapter provides a decision framework for globe law selection under Article 4.5. 4.4 is deferred tax adjustments. 4.5 is globe law selection. The election offers an alternative to the standard deferred tax accounting, creating a 15% DTA on losses regardless of local treatment. Understanding this election is beneficial versus detrimental is critical for optimizing an MNE group's pillar 2 position. Okay, so let's understand what is the simplified adjustment. Are you with me? Is that background clear? Okay. The Globe framework's reliance on deferred tax accounting creates an inherent problem for entities in zero tax or very low tax jurisdiction. Losses incurred there may generate no deferred taxes under local accounting rules, leaving groups unable to offset past losses against future profits when calculating the jurisdictional ETR. Now, let's pause there. What does it mean is, you remember something called a DTA loss recast, from the previous session. What does DTA loss recast? What is DTA loss recast? No point in reading what is there here. Like it's from something from a previous chapter. What is DTA loss recast? I think it is there here. Yeah, recast upward. What is this? Yeah, you remember this adjustment? What it means? This B in red. What does it mean? Come on, guys. I'm trying to bring you up into perspective so that you can understand these and appreciate these things. Otherwise, it becomes very difficult. Huh? If you can't, why such a law selection has come to understand and to make sure that it stays in memory. You don't remember what is law? Yeah, I'm getting some answers. So, consider DTA to 15% of the loss. Can you elaborate it a little bit? What is consider DTA to 15% of the loss? Um, in what context does it apply? Like some more. Yeah, Sahil says increase it up to 15%. So yeah, I mean, I think that's good. So basically what it means is, let's say that my deferred taxes, my financial statements, okay, let's look at my financial statements, and let's say my tax rate is 9%. Okay, we are in UAE, my tax rate is 9%. Would there be a DTA recorded in my P&L? Yes or no? Would there be a DTA recorded in my P&L if I have a loss? My tax rate is 9%. Absolutely yes. Right? It would be recorded at 9%. And through the loss DTA recast, what did I tell you? This 9% you can recast upward to 15%. Correct? Global's DTA can be recast upward. Now I'll give you a situation. This company is in a jurisdiction which has 0% tax. Okay, if it is having 0% tax, do you think in the financial statement would it have a DTA? Let's say it's in a 0% tax jurisdiction. In the year it is having a loss. Do you think the financial statements would carry something called DTA for that loss? No, absolutely not. Why? Because it is worthless. It does not have any use at all. So if I go on a standard basis and my starting point is deferred tax, no, in financial statement. So my starting point itself does not have 0%. I mean, does not have DTA in respect of 0%. What will I do? I will pay 15% tax tomorrow and still I will not get any loss offset. Correct? This year's loss will not be offset next year because my original DTA was 0%. I can't recast it also because it is not there in my deferred tax expense at all. Are you with me? Are you understanding? Yeah. So that's what they're saying. So that creates a problem for low tax. So losses incurred, it creates an inherent problem for entities in zero tax, not low tax, zero tax jurisdiction. Losses incurred there may generate no deferred tax asset under local accounting rules, leaving groups unable to offset past losses against future profit when calculating jurisdictional ETR. Is that clear? The problem with zero tax jurisdictions, there won't be any DTA. Whenever this DTA is recasted, that's what I used to adjust with future profits. But since I don't have a DTA itself, there is no recast at all. So a zero tax has no base against which to recognize DTA, meaning losses simply evaporate for GloBE purposes while profits trigger a full top-up tax exposure. Understand? Tomorrow, if I have profit, even if my tax rate is 0%, I have to pay a top-up tax of 15%. But since if my losses, since it does not generate something what we call as a DTA, it creates a problem. I can't recast it upwards also. Isn't that a genuine problem for zero tax jurisdictions? Loss cannot be set off. Profits would be taxed at full 15%. Are you getting these paragraphs? Yeah. So that is why there is something called GloBE loss election addresses this asymmetry by allowing groups to create a deemed DTA at 15% minimum rate regardless of the local tax pay. So 4.4 you can go upward only if what? Only if there is already a DTA. Already a DTA at 9%, I can recast upwards. But if there is no DTA at all, there is no recast at all. So that is why this GloBE loss election would make it 15% nevertheless. Even if you have a DTA in your books, or if you don't have a DTA in your books, if you genuinely incurred a loss, which is a GloBE loss, you will get it to 15%. Clear? But this election you have to take. Yes or no? Clear, not clear? Hello? What about others? Now, this is very important. You need to understand this particular thing that happens for zero tax jurisdictions. There won't be any DTA, so there won't be any recast upwards. So I end up losing my carry forward loss at all. Okay? Is that clear? Yes, no, what is bothering you? I'd like to have. Otherwise, we cannot proceed, guys. You have to let me know. Melvin says clear. Ashik says okay. How do you end up losing if they have never had DTA in the first place? Correct. See, my point is since they didn't have DTA, wait, I'll explain. So let's take this, so let's say that this left part is a 0% jurisdiction. Okay, it's a 0% jurisdiction. Okay, now year one, it has a loss of let's say 3 million. Okay, is there any DTA? DTA? Absolutely no DTA. Correct? No DTA. But is this loss a globe loss? Yes. Right. I mean, after all the adjustments, let's say this is globe loss. We have a globe loss of 3 million. Absolutely no DTA. Now, no DTA in the books means no recasting. Yes or no? Okay. Now, let's take the same situation, same jurisdiction. In year two, what will happen is I have a profit of let's say 3 million. Okay. What would be my top up tax? What would be my top up? I just tell me the rate. I don't need the number. What would be my top up tax? Total 15% because this 3 million is charged at 0%. So the top up taxes, so tax at, right. Since there was no DTA that was recognized last year, can I adjust this tax? Should I pay 15% or can I pay 15% minus the loss DTA? There is no DTA, guys. There is no recast, also no DTA in the books. So the ETR, would be at 15%. Now let's take another jurisdiction. Okay, let's take, some other jurisdiction. Now let's say this has a 9% or 10%. I'm taking 10% for simplicity. 10% tax rate jurisdiction. Okay. Now let's put the same example. In year one, it has a loss of 3 million. Correct? So what would be the DTA in the books? Now you have to tell me the number. What would be the DTA in books? What would be the DTA in the books? Not 15%. What would be the DTA in the books? 300,000. Absolutely. So I will have a DTA of 300,000. So this would be a negative figure in my current taxes, right? That year, would I pay anything? No, because I'm having a loss. Since I'm having a loss, there is no top up tax. The ETR, the covered taxes would have a DTA which is negative. Clear? Now let's roll forward to next year. In year two, what happens is this becomes a profit of 3 million. Okay, what is my top up tax? What is my top up tax? That is going to be 15% minus 10% or 5%. Sorry, 10% into 3 million, right? So this would be what? This would be 150,000, correct? Absolutely. So this would be dollar 150,000 would be my top up tax, right? But I have a loss DTA which is there at 3 million. Yes or no? Hmm? That 3 million, can I recast it to 15%? This is in 10%, right? I can recast it to 15%. So what would be the amount of, so it would be, I would have 450,000 as my opening DTA, correct? Now this year I have to pay 150,000 top up tax. Hmm? How did I get 150? 15 minus 10. Now you tell me, this is not the act example. Like, what will happen is, this is not what happens in reality, guys. Actually, I have a profit of 3 million, let's say. Okay. What would be the tax, domestic tax that I pay? The tax rate is 10%. What would be my domestic tax rate? That is going to be 300,000. Yes or no? This is going to be my domestic tax rate. And my top up tax is going to be how much? We calculated top up tax. Top up tax is going to be 15% minus 10%, 3 million I already paid, into 3 million. That is going to be additionally what? 150,000? Yes or no? So what is my total tax liability? Total is 450,000, right? Yes. How much do I have DTA? 450,000. So can I set off? So how much will I pay? How much GloBE top up tax would I pay? Out of which 4450, 300,000 I'll set off with domestic taxes. Rest would be set off against this. So how much will I pay? Nil. Are you understanding this? Okay. Now let's come here. What about here? What is my top up tax? 3 million into 15%, right? 3 million profit into 15%, that is equal to 450k. Do I have a DTA to kind of like, set it off? Do I have a DTA to set it off? No. So what will happen? I will pay the full 450k as top up tax. So you understand the problem that is facing by zero tax jurisdiction? There is no DTA that is recognized in books, hence no recast upward. Tomorrow, if I have to pay this, I have to pay it in full. I will not get any set off. It's a very crude example. Okay, this is not how the working is done, but this is just to kind of make you understand. So, is it clear? Isn't it a genuine problem that is faced by zero tax jurisdiction? Did you understand your question was Sahil? Um, how do you end up losing if that you had never had DTA in the first place? You end up losing because there is an option for recasting which you can't apply because you didn't record any DTA in the first place. When you pay top up tax, you can't recast upward anything as a loss. So isn't this a genuine problem for a zero tax jurisdiction? Oh, fantastic. So now let's read this so that it should be very clear. The GloBE framework's reliance on deferred tax accounting creates an inherent problem for entities in zero tax or very low tax jurisdictions. What is that problem? Losses incurred there may generate no deferred tax asset under local accounting rules, leaving groups unable to offset past losses against future profits when calculating jurisdictional ETR. Okay, no DTA, so no past losses cannot be set off with future profits. A zero tax has no base against which to recognize a DTA. No base to recognize a DTA, meaning losses simply evaporate for GloBE purposes, while profits trigger a full top-up tax exposure. Did you understand that? Yeah? The GloBE law selection addresses this symmetry. I've not talked about GloBE law selection yet. I'm saying it will address the symmetry, but did you understand the asymmetry? By allowing groups to create a deemed DTA at 15% minimum, regardless of the local tax treatment. The selection offers genuine benefits for zero tax jurisdictions, but comes with significant trade offs. We'll discuss all that. All other deferred tax attributes in the jurisdiction are equal. Groups must carefully analyze their position before electing. The simplicity and loss benefits may be outweighed by the loss of valuable details would otherwise. We'll see all that, but did you understand what it is trying to solve? Okay. So, what is GloBE law selection? Okay, let's understand. So, GloBE law selection allows, as per Article 4.5, be very clear about the article number. GloBE law selection allows M&E group to replace the standard deferred tax rules, which is in 4.4, with a simplified loss carry forward mechanism that values losses at a 15% minimum rate. Okay. So key features is it's applied jurisdictional level, applies to all CEs. And once you choose that you will go for a GloBE law selection, you will go for 4.5 instead of 4.4. It applies to all the entities in that jurisdiction. Okay. And it creates a deemed DTA. So whatever is the loss, even if it's at 0%, you will now get a GloBE loss DTA equal to 15%. 15% recast even if you haven't recorded any DTA. Okay. Now, mandatory utilization must use DTA when jurisdiction has GloBE income. Replace, so whenever you have a GloBE income, then you have to set off. Replaces article, the standard deferred tax rules do not apply. So this 4.5 will replace 4.4 completely. Now, what is 4.4? 4.4 is this, my friends. 4.4 will not apply at all. Recapture and all you don't have to do. So you will do 4.5. So it's a one-time election. So you will do it with GloBE income tax return during the including the jurisdiction. So you will make with the first GIR. Okay, I think that is missing here. So in the first GIR, you will be making the selection. Okay. Now, what exactly is happening? So creates 15% DTA when the local tax rate is lower or zero. Simplifies compliance. No complex DT tracking, recapture rules, and all is not there. And guaranteed loss relief in future years. Okay, all this would be available. Now, what are the problems? All other DT attributes are ignored. DTLs will be completely ignored. DTLs that would have increased cover taxes are lost. Revocation forfeits the full globe loss. It completely takes away all your DTLs. Only this DTA at 15% will be available to you. Others are gone. Okay. So only if you have a loss, that loss you can recast upward to 15%. That's it. All the other deferred tax provisions would be lost. We'll do a lot of understanding there. So when to make the election? So this is very important. So let's say it is a zero tax jurisdiction. This is what we so jurisdiction imposes no corporate income tax. Example, Cayman Islands, Bahamas, and BVI does not have any corporate income tax. So without the election, we understood this. No accounting DTA exists. Laws provide no GloBE benefit, right? Without this election, laws provide no benefit at all. With election, laws creates a deemed DTA. So this being a zero tax jurisdiction, and during the first year, if I elect that I would be taking globe laws election, then what will happen? My loss of 3 million, even if I hadn't counted any DTA, would be used to create a deemed DTA at 15%. Okay, so I would definitely have a DTA of 450K, even if that is not recorded in my books. And then I can set this off when I have a profit in the next year. Okay, so without election, no, with election, loss creates a deemed DTA 15%. Now, if you are in a zero tax jurisdiction, definitely elect man. It's pretty good. Let's take an example, MJ Cayman Island Limited. So let's say that in year 1 to 3, they had a globe loss of 15 million. They had no DTA. In year 4, they had a GloBE income of 25 million. So there is top up tax at 15%, which comes to 3.75 million, which is nothing but 25 into 15%. Why 15%? Because it's a 0% tax jurisdiction. In year 5, there is a GloBE income of 10 million. So top up tax at 15% is 1.5 million. Now, this is without election. Okay, so without election, whatever is the GloBE income earned, you have to tax at 15%. So in such a scenario, what would be the total tax they will pay? 3.75 plus 1.5. So in 5 years, I will pay a 5.25 million pounds of taxes without the election. Is this clear? This table? Now, what happens if I take election? What if I take election? Now, in year 1 to 3, I have no DTA, but I will recognize a 15% deemed DTA. So 15 million globe loss DTA. I will now get a deemed DTA of 2.25 million, which is nothing but 15 million into 15%. Clear? And in year 4, when I have 25 million and my top up tax rate is at 15%, so this top up tax I will reduce from my deferred tax asset. So 3.75 minus 2.25, I will only pay 1.5. And third year, since this 2.25 is completely exhausted, I will pay the whole 1.5. So in such a scenario, what would be the total tax I will pay over the 5-year period? 1.5 plus 1.5, I will only pay 3 with this election. Are you understanding this for a zero tax jurisdiction? This is just a subset of what we did. Only thing is we'll get a globe loss of 15%. Oh, fantastic. So that is the thing with a zero tax jurisdiction. Okay. Do you think we should take this everywhere? Okay. Let's discuss the low tax jurisdiction with simple operation. So if it's a low tax problem is, my friends, you can take this globe loss DTA, but all the other deferred taxes would be lost. All your DTLs, all those which will increase your covered taxes would be lost forever if you take this election. Okay. So let's take one more, if it is low tax jurisdiction with simple operations, let's say jurisdiction has a tax rate below 15%, example 9 to 12% with minimal timing differences. This is UAE. Accounting DTA on losses typically at domestic rate less than 15%, although they may be recast to 15% under 4.4.3 if global loss attribution is demonstrated. That's fine. So if you have a DTA, it would be at 15%. With election, DTA is at 15%. No attribution demonstration required. Minimal other deferred tax use. So basically, what they are saying is, if you don't have much DTLs and all, and your deferred taxes made up predominantly of uh, the losses, then you take it, man. You will 9% will become 15%. Let all these DTLs go. In UAE, definitely there won't be any chance of DTL, right? Unless you take a realization option, or there is no accelerated depreciation like DTLs which could come anywhere. So if you take this option, you don't need to track your DTLs tomorrow. All those would be pretty easy. So likely recommendation is likely elect. So provided there are no significant DTL which will be lost. Are you understanding? Like, you will only get this 15% loss thing. Nothing else. No other deferred taxes at all. And no recapture, no need to do anything that we learned in 4.4. Now, if it's a high tax jurisdiction, so jurisdiction has a 15% or more as tax rate, let's say Germany or India. Now, the accounting DTA already is a domestic rate, which now we will reduce it to 15% global, right? There is a recast, there is a cap of 15%. Election would produce the same loss DTA, but will lose the benefit of DTLs. So, in case of a high tax jurisdiction, since you will lose your DTLs, do not elect. Okay. So low tax jurisdiction with significant DTLs, so let's say just like 2.2, it's a low tax jurisdiction, but you have significant DTLs. Then DTLs increase cover taxes. Higher ETR means less top up taxes. So you will lose your DTLs completely. Hence, you should not take this election. So election would ignore these DTLs entirely, and loss benefit may not offset DTL loss. So you should not elect in case you have major DTLs. Why? This DTL will increase your cover taxes, right? This is a part of deferred tax adjustment amount. DTL will increase cover taxes, increase the numerator. If you take these options and if you have significant DTLs, you will all lose everything. Okay. So let's take an example. Let's say MJ Singapore has 17%, is in a jurisdiction which has 17% tax rate. So year one was at a loss of 5 million, and DTA. So this is a standard approach, a standard 4.4 approach. So you have a loss of 5 million. So you have a DTA at 15%. Even though it is 17% tax, your DTA and DTLs will be capped at 15% for Article 4.4. So you will get 750K as your DTA. And in year one, there is a DTL also at 400K. Okay, so net benefit is 750 plus 400, 1.15 improvement to cover taxes. That if you take a global action, that 5 million DTA at 15%, you will get 750K, but this 400K will be ignored. So the net benefit would be 750K only. So since it kind of brings your numerator down, you may have to pay additional top-up taxes. So in such a scenario, even if you are in a low tax jurisdiction, if you have significant DTLs, do not take it. Okay. And also, if you have an eligible distribution tax system, you remember this EDTS? If you have EDTS, Article 4.5 explicitly prohibits the globe loss election for EDTS jurisdiction. You should only go by 4.4, not by 4.5. Reason is EDTS has its own special treatment under 7.3, which we will learn later. Okay, but if you have EDTS, do not use 4.5. Okay, don't worry, it will be clear more. We will do so many examples. Don't worry. But the whole thing is like, you will lose all your DTLs. You will only get a lost DTA. That is the election that you are taking in. Okay, you will lose all these things. You will not get all the DTA and DTLs. Rather, you will only get a loss DTA, which is recast to 15%, even if you are in a 0% tax jurisdiction. So mechanics, how does it create? So the net globe loss for the jurisdiction, creating the globe loss DTA, net globe loss for the jurisdiction into 15%. As simple as that. So calculate the net globe loss for the jurisdiction, aggregate of all CEs, multiply by 15% rate and add to the globe loss DTA balance. So year one, if the net globe loss is 8 million, globe loss DTA is 8 million to 15%. So year two, net globe loss is 3 million. Then you have to add this again at 15%. So loss you can get at 15%, others are all ignored. Okay. So DTA usage is minimum of globe income into 15% or available globe loss DTA balance. Okay. That is the minimum that you can set up, obviously. So what they basically mean is if the net globe income is 12 million and the available DTA is 1.65 million, potential usage is, see, you have a globe income in year three. So what would be the top up tax that you'll pay? 1.8 million. But actual usage is minimum 1.8 million and 1.65 million. So 1.65 million available DTA is what you will be using to set off. So this will be added to your cover taxes. Don't worry. I think since these are simple, I'll just go back to the main discussion, which is we'll do a question together so you will understand. Okay. So year three ATR calculation, globe income is 12 million. So let's say current cover taxes is zero. So globe loss is this. And this would be used as your top. So, okay. So if you do a side-by-side analysis of 4.4 and 4.5, loss DTA rate at domestic rate may be recast to 15% under Article 4 if globe loss attribution is demonstrated. But it is always at 15%. Whatever is the loss DTA rate, it is always at 15%. Here also it is always at 15% only. Domestic will be recast to 15%, and if the domestic has more than 15, you will recast it to 15. But other DTAs and DTLs, except those from loss DTAs, would be completely ignored in 4.5. Here it is included or excluded in time. So recapture rules will only apply in 4.4, 5-year recapture rule. It is not applicable in 4.5. Complexity, it is very complex. 4.4 is extremely complex. You have a lot of recapture rules and others, but here it is only DTA, loss TTA only. No other deferred tax would be allowed here. Filing, there is no separate election. It is the default one. If you don't elect for this, then this would be default. But here you have to elect and you have to file with the first GIR. There is no option of revocation here. Like, if you don't select in the first GIR, then you're always stuck at 4.4. But if you choose 4.5, and let's say that tomorrow, if you're migrating back to 4.4, you can do that. But what happens is your DTA loss balance will go to zero. Okay. So that is what it is. So vendor standard approach, which is 4.4 wins, if it's a high tax jurisdiction and the DTA is already at 15%, uh, then it is better to go with standard approach because you will get 15% of DTLs also. Here in the 4.5, you will lose all the DTLs. Yeah, significant DTLs and accelerated depreciation intangible will be lost. Complex DT position. Okay. So when this would win, it is a zero tax jurisdiction, then it makes sense to come to globe law selection. Otherwise, it is, and also if you are overwhelmed by the compliance complexity, then also you can come to globe law selection. Okay, let's do this question, and so that I think it will clear everything. Okay. So what I'm trying to do here is MJ UAE LLC is somebody with a tax rate of 10%. I've already kept it 10% instead of 9 so that it's easy to calculate. Okay, so this is an entity which has a tax rate of 10% and it has the following things. Okay, the first year it has a globe loss, so there is no local taxes and detail movement. So in this scenario, let's do what happens if you are in a standard 4.4, and then loss selection 4.5. We will do this together so that you will understand. It's very simple, guys. It's only that you just have to be careful about this example. Let's do. Yeah, let's understand step by step what happens instead of reading theory. I think that's more better. I'll just take a new spreadsheet. Okay. So what are we trying to do? We are trying to find the top up tax in each, right? Yeah. So let's first do, so we will say, we will first do what? 4.1 or 4.5 or 4.4? Which do you want to do first? Same scenario in both the scenarios. Like same scenario in both the options. Which one do you want to do first? Globe law selection or standard? Which do you want to you do first? Okay, we'll do standard then. So standard means what? So in a standard, so it is 4.4. Okay. So let's say this is amount. What is the, it is in dollars. Okay. So this is dollars, and what we will do is each year we will calculate what is the DTA, what is the DTL, what is the top up tax. Okay, fine. So let's do year one. Just increase it a little bit. Yeah. We'll do year one. Okay. So what is happening year one? I have a globe loss, right? I have a globe loss. So would I have a DTA? I have a globe loss. Would I have a DTA? How much DTA would I have? Hmm? How much DTA would I have? 500,000 in my books. Yes. Okay. So DTA of 500,000, which I mean, I'm recasting upwards to 15% because it's a standard option, right? It's not a 0% jurisdiction, it is a 10% jurisdiction. So it would have DTA, which I am recasting upwards, correct? Okay. So this 500,000, okay, what was the amount? 5 million, right? Yeah, 5 million. It's actually 10%, which, but I am recasting upwards to 15%. Correct. So what would be my DTA? Yes, I will have a DTA of 75,000. So 750,000, 750K, I'll have a DTA. Okay. So what would be my DTL? DTL, they have given that uh, there is a DTL of 200,000 increase in DTL. Okay, this year's deferred tax expense is 200,000 because of some accelerated depreciation. Okay, so DTL is going to be what? 200,000 is what is calculated in 10%. So divided by into 15 by 20. Yes, this also I can recast upward, right? DTAs and DTLs I can recast upward. Yes or no? So this is going to be my DTL. What is going to be my top up tax? What is going to be my top up tax for the year? 750K only? No, no. Sai, we are doing for standard, not the globe loss option. So first we'll do standard, then we will do globe loss option so that we'll understand what is the difference between both. What is my top up tax? I will not have any top up tax, right? Because I am in a globe loss situation. Yes. So what is my top up tax? It is going to be zero because I am in a loss situation. So this completes year one, right? So this I'm just gonna give negative so that we understand. Okay. So what is my total like? I think I need this. 1 second, guys. 1 second. Let me do some adjustment. Give me 1 second. Sorry, then few. Yeah, sorry. I had few Teams things to take care. Okay, I'll just roll this setting. It's not on. Okay. So DTL is going to be how much? 200,000. And income tax is going to be zero. Is it clear? Yes. Okay. So my first year, so my first year, okay. My first year, I have a deferred tax of 750 deferred tax asset and DTL and top of taxes. Okay. Now let's go to year two. Year two, what is happening? What are they given? The loss is again a loss, right? So in that situation, what would I do? DTA, I will have an addition of 3 million into 15%. Yes, yes or no? And what is the increase in DTL? They say that the DTL has increased to 150,000. Okay. So DTL has moved 150,000. So that is, what would be the top up tax? Top up tax would be zero because I'm again having a loss. So what would be the net amount that is coming after year two? This year I have a loss of 450 and I have a carry forward balance from first year of 750. Total I have 1.2 million of uh, total I have 1.2 million of DTA and 200 plus 150. I have 350 of DTL. Top up tax is still zero. Okay. Is this clear till now? We are just using the standard means. Yes or no? Shall I go to year three? So in year three, what is my globe income? What is my globe income? 10 million. Right? So would I have a DTA? No. What would be my so DTL there is a reversal. So DTL there is a reversal of 100,000. Okay. But this time I would have to pay top up taxes. Okay, there is a local tax of 1 million and a top up tax of 5%. So totally how much tax will I pay on 10 million? 1.5 million would be my top up taxes. I mean total taxes, local plus top up taxes combined. Yes or no? So what would be my total taxes? Will be 1.5 million. What is my DTA balance? What is my DTA balance? 1.2 million. So how much? So can I say that this whole DTA would be reversed? And it would be used to set off top up taxes. 1.5 million minus 1.2 million. So what would be my top up tax? No. Yes. No. What is 0.3? Let me see. So DTL is so what is my DTL balance? We have to find top up tax. So what is my DTL balance? DTL balance is 350, and they say that this year there has been 100,000 reversal. So DTL is how much? 250. Yes, 350 was my DTL balance. This year there is a 100,000 reversal from it. So it is 250. So DTL balance becomes 250. Correct? So now we have to calculate our top up tax. So what is my domestic tax? 1 million. Yes. Plus 250. No. I'll do one thing. Let's do this question tomorrow because everybody is, kind of gone out of the window. We'll do one thing. We will start this, session tomorrow morning itself with this question. Okay? Because seeing your faces, I am finding it terribly hard to kind of explain because this is becoming a little nuancing. But understand, just go through this. I'll share the PPT also. Tomorrow morning, we will do this question fully. Okay? So I'll see you tomorrow morning, first thing I come here. Okay?